All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Wednesday, everybody. Today is May 28th, 2025. The top story this morning is Japanese automaker Nissan continues fighting for their survival. These guys have been making the press an awful lot lately. We have seen plants close, thousands of layoffs. We saw last week they were doing a sale leaseback agreement with their headquarters. They're doing everything they can to raise money. They're trying to raise $7 billion to survive here, selling off their stake in Renault, issuing new bonds. And then this morning, my moderator Mish caught this one. They're looking for a $1.4 billion loan guarantee from the government of UK. Why is England looking to bail out Nissan? Maybe bailout's not the right word here. This is a loan guarantee, which means it's not a bailout unless Nissan defaults on the loan, in which case the UK taxpayer would eat the loss. Then, yeah, definitely a bailout in that scenario. But really, this is the UK government co-signing on a loan, if you will. Why would they do that? We'll talk about why in the article there. It's also going to put some pressure on the Japanese government to lend a hand to Nissan. Look, guys, we're kind of like headed on this course. I've been saying this for close to a year now. We're heading towards cash for clunkers 2.0. The auto industry is in really bad shape here. Nissan is the worst example of this, but all of the automakers have posted some pretty bad numbers, Tesla in particular for other reasons. But trouble continues in Japan. Trouble continues in the auto sector this morning. Now, also more trouble in Japan, not auto related. Once again, back to the Japanese bond market. We've been talking about this for 2 days in a row now. The Japanese bond market has been getting a lot of attention, and rightly so. Japan could be on the brink of a financial crisis here. Now, yesterday, things were going pretty well in the Japanese bond market. We talked in the morning live stream about how the finance ministry sent out this survey that kind of suggested they were going to pull an old Janet Yellen, issue a lot more short-term debt instead of long-term debt, kind of manipulate the issuance in order to control the yield curve a little bit better. And the market rallied on that news that at least suggested to market participants that the government was aware of the problem. Hey, that's progress, I guess. Well, then they had a 40-year bond auction last night while we were sleeping in Japan, and it did not go well. That 40-year bond auction saw less appetite for that long-duration Japanese debt than it was expected. It stopped that rally in the super long bonds, immediately swung back to a sell-off. Yields are a little bit higher this morning, not all that much higher by about 5 basis points. But whatever buying spree we got from that questionnaire that was sent out of that survey, that is now behind us. And so the Japanese bonds are selling off again, which means the losses are getting worse here. Now, we've had two stories this morning. First of all, the losses from Japan's life insurers, $60 billion just among the top 4 life insurers in Japan. That is 4 times what the unrealized losses on bonds were last year in the first quarter. A 4x increase in those unrealized losses. That is a big problem, guys. Billions of dollars hiding on their balance sheet. And, well, it's not actually a loss until you sell it, right? That Beanie Baby collection that you bought in 2000 for $50,000, it's still worth $50,000 unless you sell it, right? You can only get $10 for it on eBay, but that's besides the fact. Nope, it's worth $50,000 because that's what I paid for it. It's basically how these insurance companies and banks have been transferring all these losses to their held to maturity category. That way they don't have to mark them to market and they don't have to admit what they're actually worth. Now, it's not just the life insurance companies. The Bank of Japan, the Japanese central bank, they're sitting on a mountain of losses. As a matter of fact, their paper losses at the Bank of Japan have tripled from a year ago. They are sitting on 28.6 trillion yen worth of unrealized losses on Japanese bonds. That's a lot of yen. Now, if you don't speak yen, that's about $200 billion almost. And relative to the size of Japan's economy, that is freaking huge. The BOJ is sitting on a huge pile of losses. The insurance companies are sitting on a huge pile of losses. Who's between the insurance companies and the central bank? You've got regular banks in Japan. We're not hearing a lot about the banks in Japan right now. We should be. It's like that elephant in the room. Nobody wants to talk about it. Gee, if the insurance companies are screwed and if the central bank is sitting on trillions of yen in losses, Probably the banks are in pretty bad shape. Oh, no. Shh. No. We don't talk about banks. We don't talk about bank failures on the internet because that's misinformation and that's fear-mongering. We're supposed to wait until it's a crisis. Then we talk about it and we act surprised. How could we not have seen this coming? Somebody going to address the Japanese banks? Anyone? Some of you guys in the back? I guess not. But that's the next thing we're probably going to hear about. And remember, guys, losses from unrealized bonds, that is what torpedoed Silicon Valley, Signature, and First Republic banks. Also going on this morning, the whole stock market is waiting with bated breath. Nvidia earnings are after the bell today. Who knows what they're going to report? The big question is China, that big change from the Trump administration to disallow the H20 GPUs to be sold to China. The H20 was Nvidia's custom-built for China chip that they built specifically to get around those export controls. It looked like everything was good, and then the Trump administration said, nope, you need an export license to sell these to the Chinese, which is a de facto ban. We don't know how big of a hit NVIDIA is going to take because of that H20 ban. I've seen the number $5 billion thrown around a lot, but that will make or break NVIDIA's earnings after the bell today. We've also got Honeywell is set to break up into 3 different companies. We'll talk about that one today. State Street is pushing yet another private credit-backed ETF. They are trying to sell this hot garbage to retail investors like crazy. They're just create a new model, create a new fund, create a new this, whatever we got to do, sell it to suckers, and we'll say we're democratizing finance. That's how we'll spin it. We're going to expand access to lucrative, high-yielding private credit. Yeah, we're going to look for retail investors to hold these bags of dog shit for us before we mark them to market and admit what they're actually worth. Friends don't let friends buy private credit ETFs. And last but not least, GameStop has bought almost $500 million or more than $500 million worth of Bitcoin. They are now the 3rd company to do so. You've got Strategy, obviously, Michael Saylor's Infinite Money Glitch. You got Liberty Media, whatever they call DJT, Trump's media company. They're buying Bitcoin, borrowing money, selling stock to buy Bitcoin. And now you've got GameStop. And it looks like whatever causes winter this time around, it's probably going to be these borrow money to buy Bitcoin companies. If they're not careful, if they go too far out on leverage, they're going to end up margin calls. They're going to end up forced selling. It's going to be ugly. Look, it's probably bullish for Bitcoin in the short term. We've got a few more months left of this post-halving rally, at least based on the calendar performance in previous halving cycles. But I've maintained my position sometime between now and likely October. There will be a major sell-off in Bitcoin. Prepare for winter, guys. Be careful what you do on leverage. We got a lot to talk about this morning. Why don't we shrink my big melon of a head and let's see what's going on in the market this morning. And don't forget that like button and that subscribe button for the YouTube algorithm so you can come on back tomorrow and have your coffee with the melon heads. Right now, the S&P 500 is clinging to positive territory, up by 7 points or 0.11% in the green this morning. We've got the Dow is just barely positive, 1 little point. Look at that. 0.1 points, just barely positive. 0.0% higher for the Dow this morning. And the NASDAQ is also in positive territory, up by 46 points or 0.21%. So stocks are kind of flat this morning. Looking over at the DXY, we have got a stronger dollar here by about 24 basis points, still below that 100 level, 99.84 for the DXY. And looking at the bond market, we've got the long end of the yield curve is a little bit higher this morning. The 30-year Treasury is at 4.965. That's higher 2.5 points. The 10-year, 4.468. That's higher by 3.5 points. The 2-year, meanwhile, is at 3.970, higher by 2 points and change. And the 1 month is little changed here at 4.282. That is down by a fraction of 1 point. Looking over at the commodities board, we've got gold is a little bit higher here. Spot gold is at $3,308. That's higher by about $7 or 0.22%. Spot silver, meanwhile, is down about a dime here, $33.15 or about a third of 1% lower, but I still like the shiny. Copper, meanwhile, is lower by about 0.7%. Platinum is higher by a third of a percent. Palladium's down again 1.1%. And crude oil is higher by 1.5% here, $61.80 for July WTI futures. Keep an eye on oil prices today. That OPEC ministerial meeting is getting underway here. They are expected to be pushing for another large supply cut. We'll see if that actually materializes. If so, that will probably send oil prices lower. And looking at Bitcoin this morning, we are off the highs from yesterday, $108,908. We spent most of yesterday around $110,000. We're down a little bit here, but still this uptrend is intact for the moment. And we've got this one in Watcher Guru today. GameStop just bought 4,710 Bitcoin worth $512 million. $500 million worth of Bitcoin for GME here. Again, guys, they are now the third company to join this borrow money to buy Bitcoin business model. It's risky. We'll see if it works out. For now, though, it is really working out for GameStop. This stock has been on a tear the last couple of days. Higher by 6% yesterday. It's up another 1% here. $35.38 for GME shares. Look at what this thing was trading at, just under $30 just a few days ago here. So decent run for GameStop over the last few days. Now, let's talk about what's going on over in Japan. First of all, with Nissan. Nissan seeks to raise $7 billion with UK government backing. Who had the UK bailing out a Japanese automaker on their 2020s bingo? That's a new one. Nissan Motor Company is facing a huge loan repayment wall next year, is seeking to raise more than 1 trillion yen, or about $7 billion, from debt and asset sales to keep operations on track, according to internal documents seen by Bloomberg News. The struggling Japanese automaker plans to issue as much as 630 billion yen in convertible securities and bonds, including high-yielding US dollar and euro notes, the documents show. Nissan also plans to take out a £1 billion, about $1.4 billion syndicated loan guaranteed by UK Export Finance. Nissan operates Britain's largest automaking hub in Sunderland. So it's that last sentence there. That large automaking hub in Sunderland is why the UK government is willing to co-sign on this loan. It's just basically a de facto bailout for Nissan. They're trying to keep those auto jobs in Sunderland alive here. That would be further industrial decline in Europe, were Nissan to be forced to shutter that plant. So for now, we've got the UK government is at least willing to co-sign, extending a little bit of a lifeline here. Now the question is the Japanese government going to act? Nissan going cap in hand to the UK for a loan may spur Japan to act. And look, Nissan is a Japanese company, and if you've got the UK government bailing them out, it doesn't really look that good if the Japanese government doesn't do the same here. Nissan Motors' efforts to obtain a loan backed by the UK government raises the question of whether Japan will be pressured to step in and also support the struggling Japanese automaker. That would be unusual, but not unprecedented. Japan's Ministry of Economy, Trade, and Industry had supervised and supported local companies in the past, from financial backing for low-cost carrier Peach Aviation in 2011 to helping consolidate LCD panel business in Japan Display the following year to create a stronger global competitor. So, look, there's examples of Japan lending support to industry directly from the government in the past. And I guess this UK loan may increase the likelihood of that. So Nissan clinging to life here. This company not by any means out of the woodwork. Nissan needs a deal here. They need to cut a deal. They need to be bought out by somebody. They were trying to get bought out by Honda earlier this year. That deal fell apart, and now they're just kind of in limbo. Now, also going on in Japan, we had this one last night. A weak auction keeps pressure on Japan to reduce long bond supply. It seems that bullish sentiment in Japanese bonds was short-lived. Japan's sovereign bonds fell after an auction of 40-year debt met the weakest demand since July, adding pressure on the government to reduce issuance of such securities. The 40-year yield rose 5 basis points following the sale to 3.335%. Yields on the maturity and the 30-year tenor last week reached the highest on record after the softest demand since 2012 at an auction of 20-year bonds. The fact today's auction didn't go very well supports the narrative that the government will adjust its issuance of super long bonds, said Kazuhiro Sasaki, head of research at Phillips Securities Japan. Wednesday's sale was a key test globally for longer tenors amid concern that rising government spending will take budget deficits into dangerous territory, you think? In Japan, it was also being viewed as an important gauge of appetite from large institutional investors who have not filled the gap left by the central bank reducing its purchases. That's an important detail there. The central bank is trying to scale back the liquidity support from the bond market. Every time they slow down just a little bit, the price crashes because nobody else wants to buy this crap. That's the problem with intervening in your country's bond market. The more you do it, the more the market becomes dependent on that intervention. Japan may have already broke it. They may not even realize there may not be any way out here. The weak bidding for the 40-year bond was probably due to the continued high volatility and the fact that the actual issuance amount will not be reduced for another month, making most investors reluctant to take on risk, said Ataru Okumura, a senior interest rate strategist at SMBC Nikko Securities. So let's take a look at that 40-year Japanese government bond. Here's the chart here. We're looking at daily candles. This big red candle here, that was yesterday's rally in prices. Remember, the yield moving lower, that's the price moving higher. So that was a big rally on that news of, hey, the questionnaire from the government, maybe they're going to do a little bit of less issuance of the long bonds. Then we had that weak auction yesterday, and we took back about half of those gains. So it looks like the rally in Japanese bonds was pretty short-lived. Now the question is, what's going to happen here? What's going on with these Japanese institutions that are sitting on all these losses? Starting with the Bank of Japan, BOJ's bond holding paper losses hit record after rate hikes. And look, our Fed is sitting on big piles of losses on bonds. The European Central Bank is sitting on big piles of losses. It's like, hey, nobody's allowed to lose money. We just take all the losses, we sweep them under the rug. That is central banks. And we just keep expanding the money supply. And then we act surprised that when we get inflation and poor people get poorer. That is pretty much the governing mantra in the entire world of finance right now, laid bare by this story at the Bank of Japan. The Bank of Japan amassed the largest amount of unrealized losses on record from its government bond holdings in the year ended March, highlighting the challenges it faces in unwinding more than a decade of extraordinary monetary easing. The paper losses from government bonds tripled from the previous year to 28.6 trillion yen. That's about $198 billion US. At the end of the fiscal year 2024, according to the central bank's financial statements released on Wednesday. And you can see it in this chart here showing the paper losses. Back in 2018, 2019, they actually had a little bit of gains on those bonds as interest rates were heading lower. Of course, then the vid happened and then the inflation. And then, okay, it's time to start fighting inflation. Interest rates start rising. And look at how year after year, the losses just keep piling up. And look, guys, this is fiscal year 2024. This is going to be even worse next year because interest rates are going to keep going higher. So how big can these losses get? I mean, theoretically, so the story goes, according to the Keynesians, central bank paper losses are theoretically unlimited. We can make this a quadrillion yen and it wouldn't matter, right? Well, no, that's not how that works. That makes inflation worse when that happens. But this is happening at the central bank. This is happening at the Fed. It's happening at the ECB. It's also happening at insurance companies, which are basically banks. This one from the Kobayashi letter on Twitter yesterday, breaking unrealized losses on domestic bond holdings for 4 of Japan's largest life insurers rose to a record $60 billion in the first quarter of 2025. This is 4 times more than the unrealized losses seen in Q1 of 2024. Nippon Life, the largest Japanese insurer and the world's 6th largest insurance company, posted $25 billion in paper losses, marking a 260% jump year over year. This comes as Japan's 30 and 40-year bonds have seen one of the most violent price declines in history. Japan's financial system is on edge. That's putting it mildly. And look, you can see it in this chart here. They're showing the size of the losses, the 4 different color bars. That's the 4 largest Japanese life insurers. You can see the quarterly pile of unrealized losses. All of a sudden, a big jump in Q1 of 2025, 4 times what we were in Q1 of 2024. And again, guys, the insurance companies are seeing it. They're basically banks. Their business models are the same as banks. The central bank is seeing it. Nobody's talking about the Japanese banks. What is going on at the Japanese banks? Shh. Remember, we don't talk about banks. We don't talk about banks being in trouble because that makes the failures happen, right? So we just ignore those problems until they blow up in our face, and then we act surprised. That's how we're supposed to talk about banks in the world of financial influencing. Well, I don't like to wait until things blow up to be like, oh, hey, there's a risk that thing might blow up. Yeah, that thing that just blew up 5 minutes ago. Yeah, that thing, it might blow up. That's not really how you're supposed to do that. Anyways, we've got Nvidia earnings after the bell today. All eyes on China restrictions as Nvidia gets set to report their results. This will be the big one. I am sure we'll be talking about this tomorrow. Nvidia continues to see massive growth from sales of GPUs, with demand for artificial intelligence infrastructure showing no signs of cooling. That's not true. There's actually plenty of signs that the demand is cooling. But for the AI chip maker, the mood is different heading into Wednesday's earnings report than it's been in recent quarters. There's one big reason why: China. On April 9th, the Trump administration sent Nvidia a letter and said it was requiring an export license for the company's H20 chip, a version of its Hopper processor specially designed for the Chinese market to comply with previous U.S. restrictions. Dating back to President Joe Biden's term, the U.S. government had been concerned that AI chips from Nvidia and other semiconductor companies like AMD can be used to create supercomputers for adversaries' military purposes. Following the new restriction, Nvidia said it would take a $5.5 billion write-down on inventory. Analysts called it the biggest write-down in the history of the chip industry. The potential impact on future revenue is hefty. This inventory write-off implies a $15 billion H20 revenue hit on a rolling 12-month basis, wrote David O'Connor, an analyst at BNP Paribas, in a report on Tuesday. So the question is, how big a hit from China are we going to see? Look, NVIDIA's been selling these things to China anyway. I mean, it's the big problem that everybody knows has been going on, and we all just kind of like pretend it isn't happening. The H100s have been sold to China like crazy. I did a whole video of Chinese influencers saying, hey, look here at my illegal H100 GPU that I'm not supposed to have, and yet I have it. Entire warehouses full of super micros, server racks loaded with NVIDIA GPUs. So how big a problem is this H20 story really going to be when it seems like the company just never really cared about export controls to begin with? That's a legit question. We won't know until after the bell. But right now, NVIDIA stock is up a little bit pre-market, $136.13. This stock has gone pretty much nowhere. It's been volatile. It's gone up and it's gone down, but we're pretty much right where we were a year ago here. So make or break, we'll find out after the bell today. Another one going on here. Honeywell enters a cooperation pact with Elliott before the breakup. This is one to keep an eye on. Typically, when companies break up, the daughter companies end up worth more than the parent company was combined. So possible Honeywell's going to be making some money on this deal here. Honeywell International agreed to cooperate with Elliott Investment Management and add a member of the activist shareholder to its board as the industrial firm prepares to split into 3 companies. Honeywell named Mark Steinberg, a partner at Elliott, as an independent director and audit committee member, the Charlotte, North Carolina-based manufacturer said in a statement on Wednesday. Elliott revealed a $5 billion plus position in Honeywell late last year and called for a breakup, saying Honeywell's conglomerate structure was to blame for underperforming shares and inconsistent financial results. In February, Honeywell said it would split into 3 publicly listed companies by separating its automation and aerospace businesses and proceeding with a previously announced spinoff of its advanced materials arm. It's a good bet those 3 new companies combined will be worth more than Honeywell is currently worth. Right now, that stock is trading up about 0.25%, $227.00. That's up about 54 cents this morning. And in the realm of hot garbage, there's hot garbage, and then there's private credit. And State Street is trying to sell more of this hot garbage private credit to you, the retail investor. State Street files for second private debt ETF, even as the first fund stalls. They have got to get this crap off of their books and onto your retirement before somebody marks this stuff to market, and then they have to take the loss. State Street is set to double down on its bid to bring private assets to a broader spectrum of investors, even as its initial ETF experiment in this area has struggled to gain momentum. And don't you just love the positive spin they always put on this? Oh, their bid to bring private assets to a broader spectrum of investors. Aren't these guys so wonderful and nice and inclusive? Oh, it's so nice of you to invite the little guys to the table. You're being generous. You're trying to spread the wealth around. Certainly not trying to parse off this hot crap onto people who have no idea what they're investing in, right? It's got nothing to do with you trying to sell snake oil to these people. No, you're trying to broaden access. The fund's giant plan to introduce its second exchange-traded fund that tracks private debt with the help of Apollo Global Management According to an SEC filing dated May 23rd, the Spider SSGA short duration IG public and private credit ETF will invest in both public credit and private credit investments, including but not limited to those sourced by Apollo. It just, guys, generally is a good rule of thumb. Like, you know how they say when you're reading the label on the food, if you can't pronounce it, don't eat it, partially hydrogenated soybean oil, whatever. Like, whatever that crap is, if it gets too, like, if it sounds like a chemistry class, it's probably not good for you. I'm going to go out on a limb and say the longer the name of the ETF, it's probably the same thing there. It's probably worse and worse for you the longer the name gets. For example, the Spider SSGA short duration IG public and private credit ETF, that's a mouthful. Stay away. All right. Apollo is looking to get their private assets off their own books and onto your balance sheet. That's what it comes down to. The filing comes even as the initial appetite for State Street and Apollo's first private credit ETF has been lackluster since its February debut. You're just going to have to go on CNBC and pump this stuff a little bit harder. I don't know what to tell you guys. People aren't buying it. So I don't know, maybe get Bill Ackman involved, see what he can do for you. Since its launch, the $54.2 million Spider SSGA IG public and private credit ETF, ticker PRIV, has only recorded 2 days of net positive inflows, totaling roughly $5 million, according to data compiled by Bloomberg. That I just love. They can't find buyers for this crap. That is a good thing, all right? That means retail is seeing through this. They're not being successful in pawning this stuff on retail investors. So at the very least, we got that going for us. But look, first run didn't work. If at first you don't succeed, try again. Here's their second one. Maybe that'll work better. Just keep selling this stuff before somebody marks it to market. And meanwhile, we got mortgage data this morning. We got the 30-year mortgage rate in the United States. The average conforming mortgage rose to 6.98%, up from 6.92%, and just shy of 7% mortgages. Important thing to notice here, guys, mortgage rates have been climbing since pretty much the beginning of September. Remember the beginning of September? That's when the Fed cut rates. They cut by 50 basis points, and then they cut by another 25 after that. We've had 75 basis points of rate cuts at the Fed, even though mortgage rates have gone from 6.13 to 6.98. It's almost like the Fed doesn't directly control the long end of the yield curve and thus mortgage rates. So mortgages are getting more expensive. Again, the housing market remains frozen. Prices are finally starting to decline, albeit slowly. And we got mortgage applications this morning. The volume of mortgage applications in the U.S. fell by 1.2% from the previous week for the period ended May 23rd, extending the 5.1% earlier to the lowest level in 3 months. So we've been seeing this. It's been dropping for a few weeks now. Let's see here. Applications for a loan to refinance a mortgage, which are more sensitive to short-term changes, they fell by 7.1%. On the other hand, applications to buy a home actually rose by 2.7%. That's curious, but to be honest with you guys, the number of home purchases now are so low. I'm not surprised to see a little bit of volatility. The market's just very illiquid here. So we've got 2 weeks in a row of fewer mortgage applications as interest rates have been rising. That is not all that surprising. And I just want to say thank you very much to my good friend, the Pasta Man. Thank you so much, Nashville, for supporting the channel, sir. He says, Anecdata, pro audio sales have collapsed. Studios and small producer purchases collapsed. And now tariffs retailer Westlake Audio filed for bankruptcy last month. We got another homework assignment, Westlake Audio. That's interesting. Should I put my AI cap on? Maybe it's because AI is going to generate all the music from now on, and all the musicians in the studios are going to be bankrupt and broke, right? Isn't that how that works? I don't know. Like AI can write country music right now. I've seen country songs written by AI. Maybe we set the bar a little bit higher than country. No offense to my country fans, but this stuff's kind of formulaic. I'm just saying, guys. It's not really Shakespearean poetry, country music. I don't know. I'm probably going to get some hate on that. But anyway, I've never been a fan of country music. I'm still not. I don't know what's really going on with audio equipment in small studios. Music industry, maybe streaming is still taking a hit. They obviously don't sell albums anymore, right? You're down to just streaming as the only source of revenue in concerts. So I take it that's probably part of a long-term trend that's been going on beneath the surface, and Maybe the threat of tariffs and maybe the struggling consumer is just amplifying that now. Entirely plausible. But thank you for that anecdata, Pasta Man. Appreciate the super chat and the support of the channel, sir. And Charles G, thank you, sir, for supporting the channel. He says, I watched The Big Short for the first time this weekend. The first time, really? I'm surprised you made it that far. I have seen that movie a lot. That is such a good movie. It really is well done. I feel like we are in the beginning stages of that again. Layoffs to housing crash. You know, the layoffs, they haven't even really started. I mean, yeah, we've seen stories of layoffs. They got really bad in like the beginning of 2022 and 2023. We had a lot of big tech layoffs. Now we're seeing some trucking companies are starting to have trouble again. Obviously, tariffs is a big question mark, but for now, unemployment remains low. Now, the thing to keep in mind, though, is beneath the surface of the unemployment, which looks okay, you've got underemployment, which is a big problem. Right, we've had a lot of jobs have been gained in the last couple of years, but they've all been part-time jobs. We've lost millions of full-time jobs. We've gained part-time jobs and we've gained gig work. And according to the BLS surveys, if a guy is homeless and he works 2 hours a week sweeping the floor somewhere and he gets paid $20 when he does it, well, technically that guy is employed and he doesn't count on the unemployment rolls. So the unemployment numbers don't really capture the labor situation. They don't capture the economic reality on Main Street because they're just like, oh, unemployment is low. It's 4.2 or 4.1%, whatever it is at this particular moment. But you don't realize a lot of those people are working. They're still way below the poverty line. And you can see it in the streets of our city. I mean, the fact that you can see these 10 cities all along the sidewalks in LA, you've got Kensington Avenue in Philadelphia. Every city has their version of Kensington Avenue or that tent city going on. So, to sit there and be like, oh, the labor market is clearly robust. How can you say that when you look at the reality that's going on the ground? Obviously, the data has been flawed, or at least the gauge isn't telling us what we think it's been telling us. So I think a lot of that is probably already happening. Now, by the time it shows up in the unemployment numbers, when they actually lay off the guy who's only working 2 hours a week or 4 hours a week, that's when things have already gotten really bad. So in my opinion, by the time it shows in the unemployment data, Charles, it's already too late at that point. That's just my hunch. I really think that the way we count and measure labor needs to be adjusted. How about monthly take-home pay? How about that's how we measure the strength or weakness of the labor market? Is monthly take-home pay on an inflation-adjusted basis rising or falling? If it's not rising, you don't have a strong labor market. Enough of all these BLS and marginally attached and labor force participation and U2 and U6 and U8 and U20 unemployment, whatever it is. What are real monthly take-home wages doing? That's how you measure the strength of the labor market. But we don't measure that. We don't talk about that. Much like we don't talk about Japanese banks. Thank you, Charles, for supporting the channel, sir. And thank you, everybody, for having your coffee with the Melon Heads once again this morning. I appreciate the super chats, guys, as well as you, my magnanimous Melon Heads on YouTube and Patreon. You guys are awesome. Thank you guys so much for supporting the channel. Links down below, should you feel so inclined. Don't forget that like button and that subscribe button on the way out for the algorithm. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.